In this session, we're going to look at the concept of variable costing. Now, by way of reference, when you did financial accounting, you were using a concept called absorption costing. Now, think about things that absorb. A sponge, right? So if you were to spill a bottle of Italian salad dressing with the water, the vinegar, the oil, and the spices, and you use a sponge to pick it up, you'd pick up almost everything. Some water, some oil, some vinegar, and some spices. But what if instead of picking it up with a sponge, you poured that bottle of salad dressing through a strainer? Well, the variable portions, the water, the oil, the vinegar, would flow through, but the spices, the fixed parts, would remain in the strainer. This is kind of the concept of variable costing. In variable costing, managers can only really impact those things that they have the ability to affect. Most fixed costs are not under their control. It's under upper management's control. The other thing about variable cost is variable costs are dependent upon activity, whereas fixed costs are dependent upon time passage. So if you think about it, the concept of a bookshelf being made in the month of January, the direct materials, the direct labor, and the supplies and the utilities and things like that, the variable portions that were used to make the product actually continued to contribute value into the next month if the item's not sold. However, what about the rent for January? Does it have any value in February? Oh, heck no. The landlord's going to be looking for a new check in February. So the concept of variable costing says variable costs are considered inventoriable, whereas fixed costs are considered to be period costs. So let's look at the example of this company here. If I were going to try to figure out the cost of a product under variable costing, I would only pick up those costs that are considered to be variable. So coming over here, we have a selling price, that's revenue. We have variable selling and administrative, that's clearly a period cost, as are fixed selling and administrative. So now these next four costs here are typically known as product costs: direct materials, direct labor, and overhead. So direct materials, variable costs. So let's go ahead and add those. And the amount of the direct materials is going to be $4. Now we're trying to just do it as a per unit cost. So we're going to go with per units. Now direct labor is also a variable cost. In other words, if we don't make any products, we don't hire any people to work. And even if we do hire them to work for us, what we're going to be finding out is that they are going to be listed as overhead because they're not actually working on the product. All right, so then we have variable overhead. That's not really a hard one to figure out because after all, it's called variable overhead. All right, so we'll go ahead and include that. Now, what you'll notice is that I ignored fixed overhead because, as we're saying, this is strictly variable product costs. So we're going to add all these together and we're going to come up with $8. All right, now in absorption costing, back to my scenario about using the sponge, we're going to not only include these three items that we used before, but we're also going to include the fixed overhead. Now, the fixed overhead, if we were go ahead and include it the way that it is, you notice something that looks a little strange? $4, $3, $1, $900? Well, why is that? Why does it look so strange? Well, the problem is it's not per unit. It's based on a time passage, maybe monthly amounts. So what we're going to do right here is we're going to move it over here and we're going to say, well, if we had $900 and we are going to divide it by units. So the question is, how many units? Do we do the number of units in beginning inventory, produced, sold, or an ending inventory? Well, let's think about this for a minute. Fixed overhead is the cost of running the factory. What do we do in a factory? Oh, we make or produce things. So it makes sense that the fixed overhead cost should be divided by the 300 units that are being produced. Or in other words, $3 of fixed overhead per unit produced in this particular period, giving us a total product cost of $11. Now, when looking at this, we compare the variable product cost of $8 to the fixed product cost of $11. Do you maybe see why financial accounting likes the absorption costing one? It yields a higher product cost, which means we have higher inventory, and we all know that inventory is an asset, and assets are considered valuable to a business. Whereas in the variable product costing, the $8 would yield a lower inventory, and that would put all the fixed overhead as an expense, yielding a lower net income. So absorption costing is acceptable under GAAP, variable costing is not. But variable costing gives managers a much clearer view of controllable costs, and actual period costs are being recognized in the period in which they're incurred, seeing as they have no value into the next accounting period. In the next session, we're going to talk about how do we create income statements utilizing both the variable and the absorption costing.